TheoTrade. This is Don Kaufman. October 9th, 2021, doing the TheoTrade weekend update here on a Saturday morning. Is buying the dip dead? Wow, that's a controversial topic that we're going to discuss in quite some extent here on this weekend's update. Let's get to work and give you a little bit of a market update. And for that, we're actually going to look specifically at some sector analysis and their expected moves. Really, how did the week end up? And I'll tell you what, buying the dip this particular week, depending upon which trading session you were in, was extraordinarily effective and not so much in the earlier portions of the week. Nevertheless, to give you kind of a quick update here in terms of sector analysis, I like to employ the use of expected moves. Now, again, for those of you who may be a little newer here to TheoTrade, the expected moves, and what I'm about to turn on as auto expected moves, is how the option market kind of depicts risk moving forward. And one of the things to look at on a day-to-day, even week-to-week basis, and I use this this particular tool just incessantly, is you can already see, of course, next week, the risk is already ultimately depicted. So from Friday to Friday, the expected move, it's what, again, the option market depicts risk to be moving forward. One of the great features, though, of it, it kind of gives you orientation of what occurred on the entire week. So this central line, of course, I'm highlighting right now, is where the week began. And of course, this is the spiders. So net, what do we do inside of the spiders? We actually had a wicked move on, of course, Monday, hitting pretty much the lower edge of the expected move, followed by a bid. That bid ultimately faded on Thursday and Friday, taking us to a mildly higher week in the S&Ps. But it's a vastly different picture dependent upon what major index product you were looking at. And this is one of the things we're going to point out here in just a few minutes about buying the dip. If you took a look at the QQQ, this is, of course, the Nasdaq. The Nasdaq not only had sell-side activity, of course, on Monday with the rest of the marketplace, but actually breached the lower edge of its expected move. Now, that's critical. That's when things really start to kind of come apart in the marketplace, only to follow with an absolutely blistering rally. But net, where did we finish on the week? Massively unchanged when it comes to the QQQ. Last but not least, again, in kind of our, our major indice analysis, you take a look at the IWM. The IWM finished the week mildly lower. Now, when it comes to sectors, one of the things that's just almost like spellbinding here is to look at the financials. The financials this week actually cracked to the upper edge, and closed pretty much on the upper edge of its expected move. So what do you have over here? You have financials exploding to the upside. Why? Well, we're going to talk a little bit about it. Interest rates, right? The interest rates coming up. Financials love it until they don't. The next aspect in here to look at financials, then you actually cruise over to the monsters of tech. Now, when I talk about the monsters of tech, this is a conglomerate symbol of Apple and Amazon and Facebook and Google and Microsoft. We start looking at this. Again, this is just like the QQQ. It finished for the most part unchanged, depending upon what underlyings you want to look at. I mean, Microsoft had just a killer bid to the upside. And this is one of the most pivotal stocks right now inside of not only the Nasdaq, but in the S&P 500 in terms of if there's going to be sell-side activity. I think that that's critically important to see that Microsoft did, in fact, finish to the upper edge of an expected move. Apple, unchanged in the week. Take a look at Amazon. Amazon, unchanged in the week. Facebook, okay, actually outside the lower edge of the expected move. So if you miss the move from Microsoft, it's probably in large part because Facebook completely offset the move of Microsoft. Last but not least over here, I wanted to bring up Google, which is also at the upper edge of the expected move. What's interesting about this, and the reason I wanted to talk this kind of through here in this market update and some little bit of sector analysis, what you've actually got within the technology, and the monsters of technology, complete and utter divergence. I mean, again, you got one stock flying, another stock down huge. You know what? With all due respect, we'll actually even pull in NVIDIA into this, which is unchanged. And last but not least, again, we can even throw Tesla in here, pretty much unchanged in the week. But some big divergences within the sector itself, which again brings to the point it's definitely a different market than we have had in previous months or even years for that matter, to see such divergence, even when the marketplace is bidding back up. There's divergence within it. Now, obviously, Facebook is news related, but looking at a product like Amazon, which has been a terrible performer on a year-to-date basis, Amazon is now almost unchanged in the year. I was actually curious to see, it finish even mildly lower, of course, on Friday. All right, so I'm going to push aside some of the sector analysis. One of the key points, though, of that sector analysis is, again, kind of that wicked divergence in the overall marketplace. The next thing we want to bring into scope over here, of course, would be a little bit of a volatility check. There's not much on the volatility front to discuss. So volatility, specifically the VIX, abated. It abated very, very mildly. But at this point, I think you should recognize something we were talking about, of course, in last weekend's update, is volatility is still very much at a crossroads. But as volatility cracked back under the 20 level, listen, you can't handicap the volatility from this point out. We're still at like this key inflection point. If you need a hedge, act now or forever hold your peace. You just got to keep thinking that, like, day in and day out. That volatility came down. Maybe this is your opportunity to get a VIX volatility spread on. Maybe this is your opportunity to mitigate risk. But nevertheless, you have a day where the VIX did finish mildly lower. Again, mildly lower, of course, on Friday, with the S&Ps down. Unusual? No. The market right now is telling you something. It's actually settling in, okay, to, well, a more volatile market. And that's one of the aspects that a lot of people are going to miss about this, is that, when you start seeing the Nasdaq's down, 0.5%, and, the S&Ps are off, but mildly off. Volatility didn't even bat an eye. Didn't care. At this point in time, again, volatility is kind of settling in. That's why I call it a little bit of a crossroads. Why is it a crossroads? Because think about what it's going to take for volatility to go up. You want to see something really, really scary? Because that's what it is going to take to see volatility rage once again. Like if you want to see the VIX over 25, you're going to have to feel the fear in these S&Ps. Those S&Ps are going to have to crack into the lower 4,000 range for things to get absolutely rocking in terms of volatility out there. Keep it in mind. The other aspect worth noting here, the volatility futures, we are just way back into contango. In fact, at this point in time, I think it's also critically important to mention, I'm no longer really looking at the October. The October volatility futures are now pretty much latched onto the VIX. And that's because they're coming very, very close to their settlement. So now we start to look at like the 39-day versus the 74-day. This is No versus Dece. And again, we're still in kind of a wild contango. That is, the shorter duration volatility future is well below the longer duration volatility future, which is, the markets are looking at this and we're just slipping a little bit lower here and there, some good volatility. But again, all right, the volatility futures are not responding. Last but not least on that front, bring up the VVIX. The VVIX, where is it? Just below the 110 region. The 110 region is a really critical inflection point of kind of feeling, like, oh, this marketplace is in serious trouble. But again, almost all of your major volatility indicators have subsided and subsided quite considerably. And one of the reasons that the vol indicators are subsiding is in the midst of all this volatility, we know one thing about the professional world. They're actually selling volatility into the volatility. How do we know that? Like, how do we know that professionals are selling volatility into the volatility? And the answer is just look at the skew. Look at the skew. Out of the money puts in the SPX are evidently being sold. And again, this looks like it's a little dot chart over here, but it's the dot plot. No. If you look at the area chart, skew has actually come down dramatically, and it's come down dramatically because you have so many professionals that are out there selling out of the money SPX puts, actually implying that they're not only knocking the skew down, but they're also knocking implied volatility down, which again puts us in kind of a very curious position. If volatility is to come raging back, again, it's going to take a very, very scary move inside of the S&Ps. All right, continuing on this particular front, bearish bonds. Bonds are the talk of the town right now. This cannot be overstated. Not only are bonds seeing absolutely epic volume, which they absolutely unequivocally are. Like, just look at the volume inside of the bond product, or if you will, inside of the notes. Okay, it is massive out there. It is steep out there, and it is very, very consistent. And one of the points I want to make, the bonds have unequivocally, okay, broken lower, which is actually taking the TNX, which is our interest rate, to oh wow, yeah, we're breaking all the way from this week 1.5 all the way to 1.6. It's ugly, and it's just as ugly as it was in the beginning of the year. It doesn't show any signs of abating right now. You know what? I'm ever the contrarian, but even I'm not selling puts right now inside of the bond product. I mean, most of the time I would step in here and be like, man, this thing is getting smacked. I'd sell some 150s or 151 puts. I'm not touching it at this point. This looks quite serious, and I'm going to explain why here in just a moment. But the bearish bonds are really threatening to stall markets as interest rates come up. And I think everybody's looking at that. Obviously, we had a dismal jobs report. Nothing to tell you on that front. The other aspect is as the bonds started to really sell off, I mean, energy is just downright scary at this point. I mean, everybody's talking about an energy crisis right now, and you need not look much further than oil, but we are, of course, going to talk a little bit about the energy sector itself. At this point, it might become a bit of a self-fulfilling prophecy, but again, we're going to look at the energy sector here momentarily for a trade idea. All right. The one aspect that I really want to resonate with you here on this weekend's update is, again, we kind of threw out the topic here is buying the dip dead. You know, it's difficult to obviously discern that could be an individual, stocks, and individual stocks, of course, are always going to bid up. But when you start looking at the S&Ps and you start looking at the Nasdaq and the Russell, I think buying the dip is going to be extraordinarily difficult. Okay, at least for the next couple of months, if you will, right to the end of the year. One of the things that we're facing right now, and it's changed quite considerably inside of the marketplace, is that we're facing this constant, what I term, merry-go-round of risks. Now, we've had this in previous years, but this one is some of the most, I think, serious headwinds for dip buyers. That the problem that you're going to get is we've had merry-go-round of risks, but this one's going to continually be headline news. One of the things that you're going to hear about just coming into Monday is China again. China and the real estate crisis is going on over there. Evergrande is actually going to default. There's no question about it. They're actually going to default on some dollar-denominated bonds over this weekend. You're going to hear about it. The next thing, of course, you're going to hear about after that is going to be interest rates. And when I say this, it's not all going to pile on you at one time. We're going to go from China, then we're going to go to interest rate fears, then we're going to go to inflation fears. Okay, inflation fears are going to lead to what? Earnings decay. And when I talk about earnings, well, earnings are coming. I think that everybody should recognize that most of the banks are actually going to be releasing earnings later this week. The XLF is about to be in play, and it's going to be in play in a really, really big way. Look no further, and we're going to talk about this in a few moments. Goldman Sachs is going to be releasing earnings on Friday, along with a few of the other big banks. But so we're going to start hearing about not only inflation from a lot of the CEOs and CFOs, but we're going to see some earnings decay. I don't necessarily think that's coming to Goldman Sachs, but when you start to get to some of the retailers out there, there's going to be inflationary pressures. Then we're actually going to hear about Fed tapering, which is going to make a lot of headlines. And then, of course, supply constraints and the Christmas season leading back, of course, to retailers. It's going to be, and by the way, I could come up with probably 20 other risks that are going to be headline news. But, of course, people are going to be like, why didn't you mention, the debt ceiling? Why didn't you mention this? These are the ones that are right in front of us. These are ones that you're going to hear. Okay, day-to-day headline news, and it is going to rock bonds. Forget about the S&P, it's going to rock bonds. And as long as these bonds have a downward trend, it's going to continue to put pressure forth specifically to the monsters of tech. There's only so much that tech is going to be able to take. Tech does not like higher interest rates. There's a lot of reasons for it, but I mean, you could talk about degenerate borrowing. Of course, nobody likes higher interest rates as a degenerate borrower. For that, I pull up Tesla. But it also really negatively impacts stock buybacks, even companies like Apple. Nobody wants to go out there and do a bond offering in a higher rate environment to buy back their own stock. So stock buybacks get threatened by higher rates. Keep that around, because that's what we're going to be facing. So we talk about buying the dip. You got to think about the merry-go-round of risks. If you're going to go out there and buy the dip, you better do it in a really smart fashion, because I'll tell you right now, these are going to be headline news that is going to continue, to kind of proliferate. And it's going to continue to whack markets time and time again. So just be aware of it, that there's nothing needed beyond just that, hey, all of a sudden we're going to actually be in some turmoil and the S&Ps are going to have a threatening day where they're down 70, 80 handles. And I'm telling you right now, this is the kind of trade action that continues to draw retail clients in. And, when I talk about, drawing retail clients in, that's just experience, people. I spent 15 years, at thinkorswim and TD Ameritrade watching retail clients, especially in the midst of volatility, get drawn back in. When I talk about getting drawn back in, we see some wild sell-side activity. Every one of these bids, the retail trader is on it, only to be taken lower. Every one of these bids, okay, retail is back in it, only to be taken lower. Every one of these bids, and you start to see a systematic dismantling, if you will, of retail traders. Is buying the dip dead? Of course not. There's always going to be days we're going to have rip your face off rallies, and I want to be clear about that buying the dip is all about the rip your face off rallies. But if you're an individual that's buying the dip and actually holding that for any more than a brief and fleeting moment, you're going to get systematically taken apart by ultimately what we term the merry-go-round of risks. All right, trade opportunities. Some really interesting trade opportunities facing us right now. Dow Performance and Goldman Sachs. One of the things I think that's absolutely critical to discern over here. If you look at the Dow Jones is what we term, okay, it's not market capitalization weighted, it's actually price weighted, which in effect means like the biggest monkeys on the block, and in this particular instance, it would be United Healthcare, Goldman Sachs, of course, Home Depot, Microsoft, Salesforce. The biggest stocks inside of the Dow are going to be the most influential, okay, in the Dow. Like, then it's just that easy. And the way that this works, and I'm just going to round this, okay, but the way that this works, and I've kind of reiterated this a lot recently, is that for every dollar move higher or lower in one of these stocks, okay, it impacts Dow, okay, by about plus or minus 7 points. It's close to 7 points right now. So why do I bring up the Dow? Because I think there's a critical trade in here. Specifically, when you start looking at like year-to-date gains, you've actually got United Healthcare that's up about 16%, yada, yada, yada. You look at Goldman Sachs. Goldman Sachs is up almost 50%. You look at Home Depot. Home Depot is actually a candidate as well, but it's up 26%. You look at something like Microsoft. Microsoft right now is up some 35%. Bottom line, the top performer in the Dow is going to take the most risk in the very near term. The trade that I'm actually doing specifically inside of Goldman Sachs, okay, forget it. I'm going to carry it right through earnings, 41 days out. I'm actually buying an out-of-the-money put spread. Now, buying an out-of-the-money put spread on this particular front, it's a little bit like what I would term like a lower probability trade. But I'll tell you what, this is not about Goldman Sachs. This is actually about the Dow. So who cares about the earnings? Let myself pass through your earnings over here. If the Dow systematically breaks down over the next, 40 days, Goldman Sachs is unequivocally going to be involved, and it's actually going to be one that's going to be hit the hardest because it's got the greatest percentage gain. It's just simply that easy to kind of handicap a little bit about the Dow. What's great about the Dow is, you have $400 stocks against what? $47 stocks. Except the same dollar movement is not the same on a percentage basis. So you know that like Goldman Sachs, again, because it's the heavy percentage gainer, in arbitrage is going to get hit the hardest. Anyway, this leads me to a $20 wide spread. You got to pay between like $3.50, maybe $4 for a $20 wide spread. It's a nice trade, though. It's a nice trade for like a little bit of a wing and a prayer over there. But if the marketplace comes down, it's going to pay out very, very nicely. The other one that I would look at right now for a trade opportunity is inside of the energy sector. Everybody is so bullish in the energy sector right now. Take a look at the energy sector. Absolutely spellbinding movement to the upside. It just is. I mean, bottom line over here, you got a breach of expected move. Okay, you got another breach of expected move, a breach of expected move, a breach of expected move, 3 breaches to the upside. Okay, 3 breaches to the upside in consecutive weeks. I mean, you could even call up here like a 4th. It's close. It's close in a few of these weeks, whether they've really breached. Like, this is pretty much on the expected move. But this is absolutely unequivocally 2 consecutive breaches of expected move to the upside. Looking for a little bit of a pullback. Just an easy in-out spread would suffice over there. You don't go out there and just wildly buy puts. And the reason you wouldn't want to wildly buy puts, if you look at implied volatility, it's elevated. At least the spread is going to offset the implied volatility factor. You just can't buy puts right now because you think we're going to go down because the implied volatility is jacked in there. And if you're wrong, you're going to get, again, systematically taken apart inside some volatility. Nevertheless, this does not constitute that I'm long-term bearish. I'm not long-term bearish necessarily inside of the energy sector. This is just looking for a short-term pullback. All right, so a trade on Goldman and trade in terms of the energy sector, onward and upward from there. The mother of all products, the SPX. So the SPX in the previous week had an $89 expected move. $89 expected move, meaning that we were expected to go down $89 or up $89, not both. Okay, it's a plus or minus, and we almost tagged the lower edge of the expected move, of course, early on in the week. But there's no question, again, the expansion of expected move has been considerable in recent weeks, and rightfully so. We're getting volatile. This next week, Okay, things did abate a little bit. Markets kind of channeled a little bit throughout the course of this past week. So the expected move came down, plus or minus approximately $80. That's still, though, that's some fairly heavy turf. The other aspect I think that's worth a mention in here is when you take a look at the SPX options chain. This is a primary expiration week, which means there's a whole lot of risk that's actually going to be packed into this week. So I think you have to anticipate, at the very least, an $80 move at the very least. Like, this is one of the weeks that I like to say, like, I'm telling you right now, I wouldn't be selling any of these expected moves in the near term. In effect, what I'm saying is, okay, I wouldn't be selling short-term options. I would not be selling short-term options. That is low volatility for some of the risk that we've seen. And all that has to happen is, again, one of those merry-go-round of risks comes out, and boom, we're going to be, down, 60, 70 S&P points in a single day. Looking at some of the back month volatility, it still reigns large. Listen, some of the back month volatility is still 21, 22%, and that's exactly why we're selling some of the back month volatility in here. Listen, that's pretty much it for this week's kind of update over here. Buying the dip, sure, there's going to be dips that are going to be bought. There's going to be people that are going to still profit off of buying the dip. Nevertheless, you have to think about, as a retail client, getting systematically pulled apart by markets. We are unequivocally in a downtrend, at least over the last month. Until otherwise noted, buying the dip is, okay, a extraordinarily high risk kind of proposition. And again, look for headline risk. It's going to continue to come out. Again, the merry-go-round of risks is not going to stop. It's going to be a headwind for dip buyers and headwind for markets. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.